Okay, so we're live now. Hello everyone, good evening. I hope you all are doing well. Welcome all to the Gulaq AMA Webinar. Let me start by introducing myself. My name is Simran and I'm part of the business and marketing team of Gulaq. We also have here with us Mr. Vivek Sharma, the investment head of Gulaq. Before we start, I just wanted to give you a quick walkthrough of what we have stored in for today's webinar for you all. As always, we would be starting with a brief introduction about ST and Gulak for the people joining us for the very first time. After that, Vivek would be talking you about the latest rebalance update, which was triggered on 30th April. So we hope you all have rebalanced your portfolios until now. Next, we would also be covering the topic on how one should go about assessing their returns, as we have been receiving a lot of queries about the same. So, we plan on talking about this in depth today and provide you with much needed clarity on this topic. Finally, we would be ending with the AMA session. We would first focus on answering the questions that we have received from you all through the Google form. We would also be happy to take a few questions from the live chat as well at the end. So feel free to drop in your questions in the chat box and we will address them at the end of the webinar. Okay, Vivek, I'll just give you the hosting rights so that you can share your screen then.
Okay. Yes.
Yeah. So if we can move on to the next slide. Yeah. Let's start by talking about ST, which is the parent company of Gulak. ST is a pioneer of systematic trading in India. It was started back in 2008 and we just celebrated our 16th anniversary yesterday. We have our PMS business, which caters to a lot of HNIs, and we are currently managing an AUM of over 1500 crores. Talking about Gulak now, Gulak is a SEBI registered retail investment advisory arm of ST. So, a little backstory on how Gulak was formed. We at ST wanted to serve beyond HNIs, making our portfolios available to a much larger audience at affordable prices. So, though the audience is different, Gulak works on the same research models as ST, but basically caters to a larger audience. Our portfolios are available both on PickRight and small case platforms. We went live back in 2020, so we have had a track record of close to 4 years now. We have served over 20,000 clients, and month on month we are just seeing this number increasing. And for that, we have you to thank for putting your trust in us. Moving on to the next slide. Let me give you a quick introduction about our team as well. So Sandeep Tyagi is the CEO and founder of ST and Gulak. He did his BTech from IIT Delhi and MBA from Columbia Business School. He has 30 plus experience in portfolio management service. Vivek Sharma is the investment head at Gulak. He did his BTech and MTech from IIT Kharagpur. He has 20 plus years of experience in trading and investment management. Eesha Gupta is the business manager at Gulaq. You might have interacted with her in our previous webinars as well. She has 6 plus experience in consulting and financial services. Whereas my name is Simran. I did my graduation from Miranda House in Economics Honors, and I've been with ST for more than 2 years now. I work in the business development and marketing team of Gulaq. We should also walk you through some important disclaimers as are there in this slide. So ST Advisors is a SEBI registered investment advisor. This is the registration number. As we all know, investment in securities market are subject to market risks. You should read all the related documents carefully before investing. Any securities quoted in the presentation are for illustration only and should not be treated as recommendations. Now, I would request Vivek to take the floor to give you the updates on our latest rebalance.
Hi everyone. So we rebalanced our portfolios on May, and these are the changes. So as you can see, our large cap allocation is pretty much the same, slightly reduced from 30% to 28%, and mid cap also slightly reduced from about 66% to 61%, and a small bump in allocation to small cap from 5 to 11%. So we are at 30, 60, 10 roughly. That's what we are currently at. In terms of allocation to specific sectors, we continue to remain bullish on healthcare, consumer discretionary, and industrials, energy sector. And in terms of underweight, we are underweight on primarily materials, IT, financials is one big sector that we are overall underweight in this specific portfolio. Okay. I would also want you to take you through the other portfolios because most of the traction that we have been getting till now is in Gulak Gear 6 because it has been giving the best returns, but at the same time, we forget about the risk. So it is actually meant for very, very aggressive investors. And I would highly urge you to check out the other portfolios as well, Gulak Gear 3, 4, and 5, in which the equity part remains the same. It has the same stocks which are there in Gulak Gear 6, but it has some debt allocation also. And I think it's important. It will be important when actually markets, because we have seen a very, very good bull run in last couple of years since we launched. We have just seen a bull run, but if the market starts correcting, at that time, I think we'll realize the importance of having debt in our overall portfolios. And I think Gulak Gear 4 or 5 are they're pretty strong in terms of returns. Also, these are Gear 6 returns. Last 1 month has been good, but I think as we always say that uh, one should mostly look at 1 year plus kind of returns. Short-term returns are mostly noisy in nature. So if you look at 1 year returns, we are doing pretty well overall. But I wanted to share Gulak Gear 5 and 4 returns also with you. So in case of Gulak Gear 5, which has 20% debt and 80% equity, and even with that 80% equity, we have been able to beat the index quite convincingly. Again, with Gulak Gear 4, these are the returns overall. We launched it in September 22, so it has limited track record, but nevertheless, it is doing very well. Gulak Gear 4, and it has 40% equity, 40% debt component in it, and 60% is the equity. Gulak Gear 3, again, we have been able to beat the benchmark multi-cap index since launch pretty convincingly here. And here, what we have is 60% is in the debt and 40% is in equity. So any investor who feels that maybe 100% equity is a bit risky, which actually it is, and maybe now is not the time to be present in 100% equity, can check out these other portfolios as well. Okay. Okay, moving on to our Gear 6. Again, Gear 6 has been doing well this year also. What we have been able to generate up until now is close to 5% alpha in last 4 months or so. And there are quite a few questions we get about our performance. And what we have been saying is that the expectations, because we have only seen a very, very strong bull run, only in 22 it was a flattish year, but even in that year, we were able to give 21% returns. And because of this fact, I think the biggest risk to our portfolios is our expectations from the market. Because when I talk to investors, most of the investors have very high unrealistic expectations. And I think if we have that kind of expectations and if we don't really achieve those kind of returns, not only in Gulak, but overall from the market, I think we are more likely to make the mistakes, which will actually hurt our portfolio in the long run. I think that is what I've been saying for the last couple of rebalances, that mostly what I see is our expectations from the market is very high. And what is good to see is what we should see at this point of time is have a look at longer term returns, let's say about 12 years, 10 years or so. And last 10 years markets normally give in the range of about 10 to 15% returns, right? So I think that is what our expectation should be from the markets. And if you talk about our expectation from Gulak Gear 6, on top of that, after the fees and all the other costs, I think if we are able to do 6 to 8% on top of that, so closer to maybe about 20% or so annualized, that's what I personally expect from Gulak portfolios. Yeah. Okay. Moving on, we published 3 blogs last month: financial planning for people in 20s, prospect theory, and also about tax harvesting. Okay, so you can go to gulak.com, check out the blog section where these blogs have been published. Okay, and we are also planning to do a financial planning for people in 20s, this session on this specific topic next Thursday at 6 p.m. And I'll urge all of you to attend this and do register for it. And also, if you have specific questions, if you want us to cover specific question or a specific topic, do let us know, and we'll be happy to cover that in the specific webinar. Again, scheduled for next Thursday, 16th April, 16th May rather, at 6 p.m. Okay. Now, a lot of questions that we get is also around the returns. How should we see our returns? And people are confused what return should they be getting. And many times what happens is the returns that they see on a small case platform versus the returns that they are seeing in their actual portfolio differ. So what are the possible reasons behind that and how actually to see it properly? That is something that we wanted to cover a bit in detail in today's session. So if you go to your small case app and see the details of overall your portfolio, these are the things, these are the particulars that you will get from that specific uh, screen that you see on small case. So there is one component which is known as current value, and current value is just whatever number of shares you have in multiplied by the current price gives you the current value. So if you actually sell all the stocks in your portfolio at that point of time, this specific value is what you will receive after selling the small case. So that is the current value of all the holdings that you have. Then there is current investment. Now, this is not the value, it differs in the sense that, let's say you have 12 stocks in the portfolio, and few you would have added this month. Let's say 4 you added this month, 4 were carried forward from last time, last month, and 4 were carried forward from last to last month. So that means you have total 12 stocks, and the price at which you invested when you entered or when you bought those specific stocks, those prices into multiplied by the number of stocks, that is the current invested value or current investment. Okay, and the current returns is just the difference between these two, your current investment versus current value. And many a times what happens is your current returns just before rebalance could be, let's say, pretty high, and as soon as you rebalance, this usually comes down a lot. And what is happening in that case is that your current value, your current investments, actually what happens is the profits that you are seeing in these current returns, which is the current profits, if you book that profit, then that profit will come under realized returns and it will be removed from current returns. And that is one of the reasons why many a times we see immediately after rebalance, our current returns reduces, but at times we forget to look at realized returns because then they will get reflected into the realized returns, right? And then there is money put in. Money put in is the total funds that you have invested, which is different from current investments, because money put in is, let's say, every month for 12 months, if you are adding 60,000, 50,000 to your portfolio, then over the last 12 months, the money put in would become 12 into 50,000, which is 6 lakhs. So that is, that represents the money put in. And realized returns, as I told you, is whatever investments in which you have already booked profits, that will come under realized returns. And total returns is current returns plus realized returns, plus there is also dividends which directly will flow to your bank accounts. All of this divided by the money put in. Okay, now that we have understood this, let's move to see how these returns are calculated and why they could be different. Okay, so let's say you invested, today is 15th April, let's say, and sometime back you invested 2,75,000. Okay, now you invested this and your total return till now is 30,000, in which your current returns is 15,000, your realized return is 12,500, which is you have already booked, and there's been some dividends of 2,500. So sum of all this would be total return. Now, when you put in this money, 2,75,000, your total return would be calculated as the total profit, which is 30,000 divided by the money put in, which is coming out to be 11%, right? Now, again, here in this specific case, what we have taken is your current investments are 2,85,000, meaning the current value of holdings at the time of their buying price was 2,85,000 and current value is 3 lakhs. Now, this is before you have invested more and your returns are showing as 11%. Now, what would happen is if you invest more, say you have invested 50,000 more. So your money put in increases from 275 to 3.25 lakhs. Okay. Your current investments also increase by 50,000 and your current value also increases by 50,000, right? But now just look at this, how your total returns will be calculated. Your returns are still the same, right? So if your returns are still the same, your total return, which was 30,000, will remain the same. And now the denominator in this would be actually 3.25 lakhs. So your total return, what it will show is 30,000 divided by 3.25 lakhs, which is 9%, right? So your returns are still the same. So the point I'm trying to make is many times what would happen is people would come up to us and say that, hey, you're showing your last 1 year return as say whatever 50%, whereas what I see is just 35%, and I have been investing regularly, rebalancing regularly, and still I don't see that 50% return. What I see is 35%. And most of the time, the reason is actually because you have added money all throughout the year. Your returns, total returns would take denominator, which is the total money you have put in. And had you put in that total money at the time of first investment, only then it would have shown 15%. But because you have been putting in money every month on month, your actual total returns in terms of percentage would actually come down. It will keep coming down because that's how you calculate the total returns. And this is one of the biggest reasons why people who have been investing regularly with us doing SIP, they usually see a difference between their total return versus what is reported on the website, right? Okay, moving on to the Q&A now. And we have few more questions that we got regarding returns, and this we'll cover in the Q&A. Okay. These are the broad categories in which we received these questions. I'll start with Gulaq PMS. Ankit has asked what's the latest PMS returns, and I have been investing in Gulaq for some time, wanting to switch to PMS. Wanted to understand the difference between the two and also the pricing. Okay, so I'll quickly take you through PMS. Our Gulaq PMS has a live track record. Actually, we launched it before we launched the Gulaq portfolios. So it has a 5+ year of track record. Last financial year, the returns were 76% versus the 40% that we got in BSE 500. So pretty healthy alpha in this. And this alpha, most of the other PMS, what they do is because they have to generate alpha, they try to generate alpha using very concentrated portfolio of say 15 stocks or 20 stocks. Whereas the good part about our PMS is we have about 100 stocks. So the returns that you see uh, has been generating using a much diversified portfolio. And the advantage is obviously because it is diversified, it is less risky, right? The approach, the methodology is exactly the same as Gulak Gear 6. Only difference is because Gulak portfolios are meant for smaller investments, and that is why they are more concentrated in nature. Whereas in the PMS, it's meant for much larger investments. Typically, the minimum investment is 50 lakhs, and that is why they are much very, very diversified and hence less risky as well, right? So these are the returns. These are the monthly returns also. Uh, Last year in Gulak, we gave about 89%. In Long Alpha PMS, we gave 76%, whereas the benchmark was about 40%. Okay. I think there was one question about the fees also. So the pricing, the fees here, it's uh, not a fixed fee, but percentage of AUM. And currently we are charging less than 1% of your total portfolio value as the fees, right? There's also benefits of switching in the subscription journey. So I think one of the benefit is obviously you get access to a more diversified portfolio, and also we take care of the rebalancing. So we have our own rebalancing algorithms in which execution, you don't need to go to any platform to actually rebalance your portfolios, and end to end we take care of the execution. I think that is the major difference, and also the difference in portfolio size and the volatility of the portfolio, because it being more diversified, it will be lesser volatile. Okay, and this is a chart since this specific model has been running. Had anyone put in 50 lakhs in the portfolio in the BSE 500, it would have been about 1.1 crores, whereas in the PMS, it would have been more than 2 crores. So that's the difference we have been able to create for our investors over last few years. Okay. Now,
Vivek, we have a question on live chat about PMS as well. They want to know the CAGR of PMS.
CAGR of PMS, I think the alpha we have created is north of 15% annualized. So over last 5 years or so, that's the alpha. But if anyone wants to go, if anyone wants to actually check out a detailed performance report and other details about our PMS, you can go to gulak.com, and there's a section on PMS. You can check out that section, and it has most of the other details. And still, if you want to talk to us, you can just leave your details there on that page, and someone from our team will be calling you back and discussing the details. Okay. So you can check out gulak.com. In that there's a PMS section, and from there you can get all the details about PMS. Okay. Any more question, Simran, at this point of time?
Not regarding PMS, I'll
Hello.
put the question up for you as
Okay.
soon as we cover the topics.
Okay. So yeah, this is one question that we got, that somebody invested in Gulak Gear 6 since Jan 1. The return on their investment is 2.8%. And when I checked the returns, overall returns has been about 10% in Gulak Gear 6 since Jan 1. So I think this could be due to multiple factors. One is, if you have been putting in money every month through SIP, then as I showed you previously, your overall return reduces because you're doing a SIP. Kindly, okay, that is one of the reasons. Second reason, again, if you don't rebalance on time, that again leads to some sort of slippage, and that could again be one of the reasons. And the third reason is also because you're rebalancing. I'll just share that data also with you about that. I'll cover the rebalance, but during rebalance also what happens is your sell value is actually greater than your buy value. So what is happening is, in rebalance, I can quickly go through it right now itself. Yeah. So what is happening is, let's say somebody put in money, 5 lakh rupees, and the small case returns have been showing as 12.5%. So your actual profit should have been 62,500, and your current value of your portfolio would be 5 lakh 62,000. right? But what happens during a rebalance, and let's say if somebody has rebalancing multiple months, every month this is going to happen, that first step in the rebalance process is it will ask you to sell some securities, sell some stocks. And at the price at which they are getting traded, that is the total sell value is coming out to be 2.6 lakhs. But the next step would be when it asks you to buy those new stocks, it really, in the ideal scenario, these two, the buy value should be able to should be equal to the sell value. But in the practical terms, what happens is because there is a fluctuation in the prices of stocks all throughout the day, the algo keeps a small buffer so that your buy value does not exceed the sell value. So that buffer, what ends up happening is you end up selling slightly more and buying a little bit less. So there is a difference of 10,000, let's say, in this specific example, that is going out of your portfolio. So every month, what could happen is a small amount of money is left unutilized because your sell value has to be slightly higher than the buy value. So that money is being unutilized and that is obviously going into your account only. But because of this, what would happen is your actual current value, which should have been 5,62,000, is actually only 5,52,000. So your returns on the small case portfolio, theoretical returns are around 12.5%, but your actual returns are lower. So you calculate the returns 5.52 lakhs on so 52,000 on 5 lakhs, it is 10.4%. So your actual returns will be slightly lower. And if it keeps on happening month on month, then the returns that you see is going to be, the actual returns would be slightly lower, right? So this is a difference. This is another piece of algorithm. Because of this rebalance, there could be a difference. And the third point that I've already told you, if somebody is not rebalancing on time, due to that also there could be a difference in returns. So there are multiple reasons why there could be difference in returns, and we got to be aware of those specific reasons, right? Kindly let me understand what kind of returns to expect. As I told you, see, over long run, you should only invest in equities if you have at least few years of investment horizon. Um, I think less than 3 years is really a very, very short term. 3 to 6, 7 years is slightly medium term, and long term would be, say, about 8+ years. That's what I consider. And the returns that I would expect is, as I've already told you, from Gulak Gear 6, if I'm able to get overall about 20% CAGR, and I know from markets it's going to be about 12% or so, plus or minus few percentage points. So if you are able to generate that, if I personally get it, I'll be very happy. And that is what my expectation is. That is not going to happen every year, right? But the average over next few years should come out to be that, right? Some years, obviously, they could be negative also, right? And some years it could be 50 plus percentage kind of returns also, right? Next question is, I want to understand more about your Sharpe ratio and drawdown coverage for the long run, Shubham. So I'll just quickly stop sharing this, and we have calculated this Sharpe ratio and drawdowns, and I'd like to share that specific Excel with everyone. Okay, Simran, can you see the screen? Excel?
Yes, Vivek, it's visible.
Okay, so I'll quickly take you, it's slightly technical. So what is Sharpe ratio? First of all, Sharpe ratio is risk adjusted returns. So your annualized return divided by risk, which is captured as the standard deviation of returns. So this specific ratio is known as Sharpe ratio. And since inception, if we calculate our Sharpe ratio is about 2.6 versus 1.7. So as compared to BSC 500, our Sharpe ratio is very good, which means for the same amount of risk, we are able to generate much higher returns in Gulak Gear 6. That's what it says, right? Now, the way to calculate is you take in the Gulak returns, monthly returns, Now we have taken the monthly risk-free rate. So this risk-free rate is the T-bills through T-bills, and this is the yearly returns. And if we convert this yearly returns to monthly returns, we get the monthly T-bill rate yield. And what we do is we calculate the excess return. So excess return is your return of the portfolio minus the risk-free rate. So in this column G, what we have calculated is the risk-free rate, and then we have also calculated the excess returns over S&P. And using these, what we calculate is the total returns from this, and this total returns is again the excess returns over risk-free rate. Then we calculate the annualized volatility, which is a measure of the risk, right? Using these two annualized returns and the volatility. Again, volatility is volatility of these excess returns. So standard deviation of these excess returns. And if you take this ratio, then you get this Sharpe ratio. Okay. This is how you calculate Sharpe ratio, and I've told you the Sharpe ratio is 2.59 for Gulak Gear 6 versus 1.71. Slightly technical. If you don't understand, maybe we can share this Excel sheet also with you, and it's okay even if you don't want to go into so much of details. In that is fine, but since somebody asked, we wanted to share this. Next is drawdown. Again, the calculation would be slightly technical. So maximum drawdown is what your how much your portfolio actually lost from the peak. In the worst case scenario, that is your maximum drawdown. Again, if you see maximum drawdown for us since May 2020, since the time we launched, is 20%, whereas Nifty multi-cap lost about 18.5%. So in terms of this, you can say we are almost there, or maybe slightly more risky, but then we are taking higher risk. But as Sharpe ratio showed, this is not undue risk. So we are able to generate excess returns and much higher excess returns by taking slightly more risk. That is what is happening here. And the way we calculate this max drawdown is, again, based on the daily return. You calculate the NAV value. So this NAV starts with 100, and based on the daily return series, you calculate the NAV value of Gulak Gear 6, and similarly you get the daily NAV value of Nifty. Now, next is you have to calculate, you have to fix your maximum, and relative to maximum, you will calculate your drawdowns. So in the next step you do is you calculate the maximum value up until that point of time. So let's say, yeah. So let's say here in the first few days you reached on 14th May, your NAV reached 102, and then it stayed at 102 for a few days till 20th May. On 21st, it made a new high of 104 and 105, and then again it came down. So what it's going to do is, in the maximum here, 102 on 14th May, again 15th May is 102, but then when the market came down on the next day, the maximum value is still remained the same, because this is my base, and from here I am going to see how much the market has come down. So in the next step, what I'll do is, in the next step I'll say, this is the formula that earlier the maximum is 102, and using that, what is my current value, which is 101, and how much have I come down relative to the maximum. And if you compute these numbers, then what you get is the maximum drawdown, right? So that is how we calculate the maximum drawdown. And if people want it, maybe they can just message on YouTube, and we'll be happy to figure out a way to share this. Maybe we'll put it in our blog as well. But that is how we calculate the maximum drawdown and the Sharpe ratios. Okay. Now I'll go back to the Q&A part. Okay, yeah. So we have covered this. Yeah, so this is the mathematical formula that we have, and this is how the chart of that maximum drawdown looks, because this is a drawdown, this chart is only below zero, right? And as I showed you, there were a few drawdowns of more than 10%, and maybe at a drawdown level, uh, this in July 22, when the markets fell about 18% from peak, we were down about 20%. But here, I think what it also shows is a good part, that we are able to recover. So when the market started falling in Jan 22, we fell maybe 2-3% more than the benchmark. But if you see this blue line, this tells you that we recovered our losses, whereas the BSE 500 was still in loss. So we recovered and made a new high here. And again, from about September, October, November till maybe December, we kept on recovering, whereas BSE 500 was still in a loss. So that's what this chart shows. Okay. Okay, Simran, any specific questions about returns?
Yes, we have a question from Amit Kumar. So he says that most of the small cases have done phenomenal in last 4 years. It is very difficult to judge anyone. If someone
Yeah,
enters the market now, what should be reasonable expectations from Gulak Year 6? And
yeah.
if market corrects, what step do you take for this?
See, reasonable expectation, I've told you. This is very hard. It's almost impossible to comment on what to expect this specific year, right? That is very short term, and most of the time it's kind of random. It's very difficult to predict what would happen in 1 year. But if you just look at the data and look at slightly longer term data, uh, I've told you my expectations. I've already shared from Gulak, from markets, so that those are my expectations. Yeah. And I think it's very correct. What we have seen in last, since the COVID fall, just one way rally. So yeah, that is, it will be good if everyone can look at longer term charts and see how markets work and the kind of returns that they deliver over long run. Okay, shall we move ahead, Simran?
Yes, Vivek, we can move ahead.
Okay, okay. So rebalancing, can we ask small case to add invest more at the time of rebalance? I think it's a very good idea. Even last month we received this, and we have already communicated this to small case. And we'll check with them where they are with this specific one. And this invest more should be made complementary. We like rebalance. Again, we'll pass on this information to small case. I'm not really sure how they'll take this, but we'll pass it on. Yeah. Yeah. I noticed an issue with small case rebalancing. When a stock outperforms and its weightage increases, the next rebalance may sell the excess shares. When a stock outperforms and its weightage increases, the next rebalance may sell the excess shares. I wonder if the calculations have been made regarding the impact of this situation akin to those. Okay. So yes, I think uh, people are slightly concerned. We got few other questions, and I think what I am seeing is because our performance in this calendar year has been the returns, I think 5% alpha. So we haven't really produced the kind of alpha that we have been producing up until now, and that is what is causing slight unrest maybe. And this has been happening, I know, but I think we are on track to do what is a reasonable expectation from that we say that this is the reasonable expectation you should have. I'd like to point out to last 1 year. So in last 1 year, I think they in last 1 year we would have taken roughly around 50 to 60 stocks in our portfolio overall. And if we look at the returns of, there'll be few winners and there'll be few losers. So the better way to judge is how many winners you had versus how many losers you had, right? How many stocks made money versus how many stocks lost money. I think that ratio would be about 75-25. So 75% of the stocks would have made money and 25% of the stocks would have lost money. Now, if somebody asks me that, what are you doing about these losers? How you can eliminate them? I don't think we can eliminate them. It's not so easy, and it's impossible that we have only winners in our portfolio. That is one thing. Second thing is also one should look at how much money these winners are making. So when your call is right, how much money you make, versus when your call is wrong, how much money you lose. And if you look at some of the best winners, they would have made about, say, about 80% to anywhere between 80 to 120%. Those are some of the best winners. Whereas the worst losers, I think the worst loser lost about less than 20, about 20%, right? So that is the way to judge, not over shorter duration and not over few stock trades, but over slightly longer term. And even I know I said ki longer term is few years, but at least take a year and then see at how many winners you had, what was the profit you made versus how many losers you had. And not only about Gulak, it could be about any strategy, any small case. I think that would be a better way to judge a specific portfolio. So these observations are mostly over very small term, and have a look at the data, and maybe we can share. We every quarter we share this data. Last we shared this data, I think, at the end of last calendar year. And I think, Nikhil, I would want you to, and we published a blog, deep dive into Gulak Gear 6 somewhere in January. And if you look at that, we have all the details in that. And that will give you a very good idea about what is happening to each of these stocks over slightly long term, right? So that's a better way to judge a portfolio, and not over very small short term. Can you please do my auto rebalance every month for, can you please do, I can give you authorization on small case. Uh, I'm afraid that is not possible. Uh, that is only possible if you have 50 lakh fees. The PMS, we take care of all the rebalance in PMS. So in PMS, regulation wise, it's not possible in any other way. PMS, we have the authority and that is allowed. But in any other case, that is not really allowed, that we buy and sell on your behalf. So that would not be possible. Yeah. So you'll need to take out what, maybe 2 minutes, 5 minutes. That's what it takes. I know I myself have missed for some reason. I myself haven't rebalanced this month. But yeah, that is something that even though it takes 2 to 5 minutes, but yeah, we do need to take out time. And I can imagine, because I myself haven't rebalanced my portfolio yet. I need to do that. Maybe I'll do tomorrow. Okay. So again, rebalancing, what's the date of rebalancing? How come we'll get to know in Zerodha? So Disha, I don't think you can get to know in your specific broker, but when you go to small case app, there it will show what is the next rebalancing date. So Simran, can you check what's the next rebalancing date? To me, I don't think it will show me the rebalancing date because I haven't rebalanced.
Let
But
me check right
anyone
now.
who has rebalanced, if they go to the small case app, go to that specific portfolio, I think there it will show the next rebalance date. So what it is showing?
It's showing as May 30th.
So yeah. So either most likely it will be May 30th or 1st of June. While rebalancing, is there any way of dropping few stocks? So dropping means we have given you a call to buy and you don't want to buy. I think yes, you can do that. Small case gives you that functionality of accepting or partially accepting these trade recommendations. So you can do that, but really, then what's the point of paying all the fees? I think we are doing that research. A big team is there, and we are looking at all the other factors, which is personally I feel it is very difficult for a retail investor to do. So we don't recommend that. You have that feature in small case, and yes, you can do it, but we won't recommend it. I invested 40,000 in Gear 6 on 1st April and decided to rebalance my portfolio on April 30th. However, after rebalance, I noticed discrepancy in my net receivable amount, which remained at 1660. I observed that purchases and sales were, yeah, this is exactly the thing that I had pointed out, Karthik. I pointed out this thing that because of the rebalancing algorithm, and obviously while rebalancing you need to keep a buffer. I know at times this buffer can be slightly more, and there is a possibility there is some possibility of reducing this buffer, this difference of buy value and sell value. We are in touch with small case team. We have recommended them that it should we should actually reduce it. There are ways to reduce it, but as of now, it is what it is. We are working with small case team to reduce it. Yeah, but this is a problem. We understand that some money is actually going out of the investments, and that's not how it should be. Yeah, we should plug this gap, and we'll work with small case to fix it. And thanks for pointing it out also. Okay, reasons behind the difference. Okay, so I've already talked about reasons, and there are other reasons also, like untimely rebalance, which is what I have done this time. And the second thing is also whatever stocks you sell, you don't get full 100% available to buy back. You only get 80% available, and 20% is actually not available to you, which actually next day it is available to you. So the whole rebalancing would take place at that point of time if you have some more margin or funds available, or else what it happens is 20% of your buy value actually gets executed the next day. So again, that could create some difference between the, excuse me, the theoretical returns versus the actual returns that you get. Okay. Okay. Any question on rebalance specifically, Simran?
Yes, Vivek. So we have a question from Gitanjali. If there is no message sent for rebalance, then whether there is no rebalance at all, or will it be rebalanced automatically?
No, it won't be rebalanced automatically. You'll never be rebalanced automatically. I'm not sure whether I understood this question.
I guess it's more to do with the frequency of rebalancing. So we have a set frequency of doing the rebalance monthly. So come what may, we do rebalance our portfolios monthly. It usually happens at the end of the month or the starting of the new month, and
Yeah,
we do send out emails to our clients regarding this rebalance. So one email is sent by us, and also the small case also updates the clients to rebalance their portfolios.
yeah.
Another question that we have on rebalancing is what is the difference in sell value and buy value during the rebalance in percentage? If we get to know the percentage, then we can invest additional amount in SIP.
I haven't really given it a very good thought in terms of percentage, how much it is, but what I know for sure is if you keep rebalancing, and if you have been with us for, let's say, more than 12 months, so 12 times you would have rebalanced it. It's a substantial part actually. And again, what is happening is because this is a money which is not getting reinvested, you're losing out on that compounding on that small part. So even if that money is, let's say, 1%, over 12 months, it could be 12% of your portfolio value on which you are not getting compounded, that is out of the system. But I don't really know how much it is. What I've also seen is it varies a lot month on month. So it's not constant. Sometimes it is very small, sometimes it could be slightly large, but I don't really have a very good idea about in terms of percentage how much it would be. But what we can do is, I'll note it down. Maybe next time we can take an actual rebalance. Some investor who is okay in sharing his overall trade history, and we can actually see how much is the difference and what has happened month on month. Difference in buy and sell value. Okay, so that is something we can do and maybe share it in next time. Okay.
We have another question from Mohit Gupta. In the
Yeah.
last 2 to 3 rebalances, after we do the rebalancing, the morning after,
Yeah.
uh, the shares starts going down. Is it that some hedge fund manager or operator is watching our shares and shorting it?
Why would they do that? It's possible, right? But I'm just wondering why would they do that? So the question is that whatever buy recommendations we give, they come down, right, Simran? That's what the question is.
Yes, Vivek.
Yeah. So my question is, why would they do that? These operators, I think, they would do such a thing only in stocks where they feel there are a lot of intraday traders and they have a stop loss nearby. So let's say we gave a buy recommendation of a stock at 100 rupees and there are a lot of traders in it, and those traders have a stop loss at 98. So if the market comes down below 98, everyone would sell, and then the again market will go up. So operators do use it, but they use it only in stocks where there are a lot of intraday traders, right? So I don't really find a reason why any operator would pick a stock of a specific small case portfolio and do it. I really can't think of any reason. These are mostly I think micro caps, very small stocks, and where there are a lot of speculation going on, right? And as far as I know, Gulak investors, most of them are long-term investors, and there are obviously few stocks which come down, but then few stocks go up. And most of the investors, they don't look at it stock-wise, but they look at it portfolio-wise, and that's why they don't get out when a stock is losing money. So I don't find any credible reason why any hedge fund or any operator would pick on somebody's stock and then try to short it, really. Yeah.
We have another question from Ravi, a question that we often get in all our webinars, that why there is a monthly rebalance, why not on need basis?
Yeah, this is a question we get almost every time, uh, and we have done a lot of research on this. Our conclusion is this specific strategy of doing rebalance on a monthly basis works better overall over long run than the strategy of doing rebalance on a need basis, and that's why we have it. So this is a better strategy as of now. Again, we keep working on our strategies, keep on making it better. And maybe at some point, if we figure out a better strategy, which is need based, we'll obviously shift to it because our mandate is to give the best returns possible with the least amount of risk. But as of now, this is the best strategy that we have. Yeah.
So that were all the questions that I could
Okay.
find on rebalancing.
So let's move on to the next questions on methodology. You choose stocks on what basis, technicals, what are the general understanding we can get from various weightages? Uh, okay, is stock X very risky but could potentially give good returns? Okay, and weightage allocation of stocks are very low. Okay, so what we do is we take our universe is BSE 500. So we'll take all the 500 stocks and we have hundreds of factors. Now, factors are anything that can impact this specific stock. So we'll create a matrix of 500 by, let's say, if we are using 100 factors, 500 by 100, where we'll rank each and every stock on each and every factor, right? So one of the factor could be, let's say, valuation. So based on valuation, starting from most undervalued stocks to most expensive stocks, we'll just rank it, right? Next step, what we do is, and these factors that I've spoken about, they are a mix of technicals as well as fundamental factors. Okay. So about 60% weightage or number of stocks, number of factors, 60% of them would be about technical and 40% would be fundamental. Next step, we look at the macro environment right now. So we look at macro fundamentals like GDP growth rate, inflation, prices of essential commodities, your currency rates, all of that. Based on that, we figure out a specific regime and we figure out what are the factors out of those 100 factors that are likely to work best. So let's say we figure out 6 factors out of those 100 that are likely to work best in the current regime. Using these 6 factors and those ranking of stocks, we'll come up with a consolidated ranking. We'll pick top X stocks, let's say top 12 stocks, and give them weightage on the basis of how we constructed in a way in order to optimize for the highest Sharpe ratio, which means that how using these 12 stocks, how can I combine it in a way that I get the maximum returns with the least amount of risk? That, in a nutshell, is our methodology, right? So when I say somebody is asked about how do you allocate, again, the allocation is primarily on the basis of two things. One is your consolidated score, and second is uh, how do we combine it in a way to generate highest returns with the least amount of risk. Using these two things, we combine these stocks. Again, all of it is rule based, very mathematical in nature, but when we get a specific portfolio, we don't touch it then. We don't question, we don't touch it. Obviously, in order to improve, we'll keep on questioning how we can improve. But at that point of time, a model which is in production, we'll use those weights and then we'll rebalance our portfolios. So that in a nutshell is regarding our methodology. Again, it's a combination of methodology is a combination of technical factors, fundamental factors, and macroeconomic factors. And because we are looking at each stock and each sector in a full 360-degree view, I think that is what the edge is. And that's why we have been able to perform year after year for last almost 4 years now. Okay. There were a few more questions regarding methodology in which they are asking about specific event risks and also election day. And yeah, so regarding that, I won't comment on a specific event, but because we are rebalancing on a monthly basis, and it's a very high frequency kind of rebalancing for investments, right? Because if you look at the way mutual funds work, again, I'm not trying to point that that's a bad strategy. This is a better strategy. That's not my intention, but it's a different way to select stocks and construct portfolios in the way um, typically mutual fund managers would do is they'll have a team of analysts, they'll study a specific stock or sector, and if they decide to buy it, they'll buy it across days because their fund size is bigger, and they'll hold it for a few quarters at least, if not years. Definitely a holding period would be few quarters, and for a few stocks it will be few years as well. And because we are rebalancing on a monthly basis, I think the advantage is that any event that occurs in the market prices would get readjusted, and that will get captured, and we'll have an updated portfolio, right? And that is why, and our skill set, our expertise is not in making these manual calls uh, related to specific events. So I would say, we'll almost never do it. Obviously, if in a very extreme, rare kind of a scenario where some news has come out on a specific stock or sector, and we know for sure that that is going to go down 40-50%. In that rare case, we would take some action. But again, that is not rule based. That is depending on that point of time, what do we feel is best. right? But it has never happened up until now. And another way to think about it is, let's say if a news has come out in a specific stock, and we know means it is happening that it's going to go down 50%. If we know, most of the market participants would also know, and the likely scenario in that case would be that even though we have given the sell recommendation, 99% of the time what will happen is that stock will be in lower circuit. So anyone who wants to sell it won't be able to sell it. So it will be in lower circuit for a few days. When it comes out of lower circuit, do we still need to want to sell it? Again, on case by case basis, we really don't know. We can't comment right now, because it might be the case that when it comes out of that lower circuit after a few days, maybe that news is priced in, and you really don't want to sell it. You actually want to buy it at that price, right? So again, on case by case basis, we'll make a decision. But up until now, we haven't encountered a case where we needed to make that uh, manual decision. Okay. So as far as possible, we'll try to avoid it. Okay. I see in monthly rebalance, half of my portfolio is sold and half of the new stocks are bought. What if we keep top 13, 14 fundamentally strong stocks and only? Yeah, see, that is a good strategy. One of in PMS, in fact, this is a part of the portfolio. We do this also. So because PMS portfolio is large, it is constructed of few smaller portfolios, and one part of the portfolio we do this. But because our Gulak portfolio is relatively smaller, we cannot do it. This is a fairly good strategy, but if you consider the best returns, if you want to generate those best returns, the current Gulak Gear 6 methodology is the best. We can do that, but the returns would suffer. So my question to you would be, if returns suffer, if returns, obviously, even in that, you'll be able to beat the index. But if your returns, instead of whatever, let's say 30% in a year, if I ask you, using this strategy, you are able to generate 25%, would you be okay? I think mostly the answer would be no, right? So yeah, that's what I would say. Okay, there are a few more questions regarding methodology. How often do you churn the debt ETF portion of Gear 3 with returns of debt? I'm trying to understand probable impact of such taxation. Yeah. So Anand, I agree. In terms of gear-based portfolios, the debt part might be slightly inefficient, because there might be some small, obviously it won't be big, there would be some small changes buying and selling, due to which that specific part would be slightly uh, tax inefficient. Okay. But that would be the case for any of your debt investments as well. I noticed the greater weightage stocks are consistently not performing. I was expecting Gulak returns to be better than mutual funds. However, few mutual funds are. See, there'll always be the case. Few much mutual funds might perform better. As far as I can see, we have done pretty well over last 1 year, and longer, last 4 years. There might be the case, and this has happened in the past, that for few months we have underperformed. Not only mutual funds, but even benchmark. This has happened last year also, where we delivered very good returns, but there were a few months where we underperformed, and years prior to that. And this will also happen in the future. So for a few months, even if we underperform, I don't think it's a matter of concern really. And again, when you say you noticed few stocks are not performing, I would urge you to look at slightly more longer term duration, and then the results will be more clearer. Yeah. When is your low churn model coming out? Frankly, I don't know. Might come out next month, might take a few more months. This is something that I know we have been working on for a long, long time, but we are not convinced yet to release it. And when we are convinced, it will come out. So it might be few months down the line, or it might be next month. I really don't have a very strong convincing answer for you, Srinivas. Okay, yeah. So I think methodology wise, we have covered anything. Simran, if there any other methodology related question, we can take
Yes.
that.
Yes, so Mobin JSR, he has been asking throughout the webinar that
Yeah.
we are considering more than 130 factors, but still our stocks are falling. Why is
Yeah.
that?
I don't see stocks falling. So again, you can look at 1 month or 15 days returns or whatever time frame, but the way I see Gulak, yeah, here are the returns. So last 1 year, you're given almost 90% versus 40%. Again, there will be few months where we'll underperform. Even last year, if you see, there will be months where we underperformed, right? In June 23, if you look at BSC gave almost 5%. We were below 2%, right? This happened. But then it happened in August also, where we gave 5%, BSC gave slightly negative returns, right? So few months every year, uh, most likely we'll underperform. There's no way we can outperform the market month on month. That's a very unreasonable expectation from any fund. I don't think we can do that. If that is any investor's expectation, I think most likely they'll be disappointed. So yeah, short run, yes, that can happen, that will happen. A better way to look at it is slightly take longer term view, and that's a better way. And I'm not talking here about just Gulak portfolios, any portfolio, be it any other small case portfolio or any other mutual fund. Look at it yearly over yearly, and that's a much better way to look at it. Yeah. Okay. Any other thing?
So Sanjog is asking, it's more of a suggestion rather than a question, that if
Yeah.
market is down because of any false news or by promoters, where you don't see any issues with the fundamentals, can you please send an update over small case or email to grab the opportunity and invest more?
Okay, we would not do that. Okay, let me just switch on the light once. Yeah. So when the markets are down, I don't think that's a good strategy. Okay. And we would not do it because when you say markets are down, anyone gives a buy recommendation. What it means is, what they're saying is it's a good point to entry. Markets will not fall and you should invest. Our take on this is, when you say that you want to invest when the markets are down, that means you are holding some part of your overall portfolio in cash, and you are waiting for markets to correct, right? And if they correct, you invest, and if markets go up, then that's a good strategy. But what is most likely to happen is, if the markets correct, what could also happen is they can keep on correcting also. So you entered and markets are still going down. Or the other side, which happens with most of the investors, is you're waiting for a correction, you're not fully invested. Some part of your, let's say 10-20% is in cash, and the markets are going up. They're not correcting. Then what do? What is happening is you're missing out on your returns. So you have 100 rupees, you have invested only 80, you have 20 in cash that you're waiting for markets to correct. But now the market has gone up and you just invested, you're just getting returns on those 80 rupees, you're not getting returns on those 20 rupees. And that's why that's not a very good strategy, really. A much better strategy is uh, invest through SIP. Every month, whatever amount of money you want to put in stocks or debt mutual funds or wherever you want to invest, I think don't worry about where markets are going. Really, no one has an idea, right? No one knows what's going to happen in next 1 2 3 months, really. And and the best strategy is just avoid all of that noise and keep investing every month, irrespective of the levels, frankly. And we have done this study. We have seen, in fact, we wrote a quite popular blog, uh, discipline versus luck. So if you are lucky, you might time the market. And if you are the luckiest investor, you might time the market every month for many, many years. And even then, your portfolio would be just 6% ahead of a disciplined investor. So this is a study that we did, and it's out there in the blog, Gulak blog also. So I think we underestimate the power of discipline, and we actually overestimate the power of timing the market. And we waste a lot of time. We take a lot of stress about it, but it's really not worth it. So I would urge everyone, just invest with a disciplined way, whatever it's monthly, quarterly, whatever, but not dependent on really timing the market, right? So that is something that we really can't help you with. That's not a really good strategy. I know
Another.
it sounds very good. I know there are other fund managers who do it. It sounds very good. It sounds that they're helping investors. We really don't think so. We really don't think so that they have a clue that whether the market is going to go up or down in short run over next few months. So yeah, that's what our take is.
One more question, Vivek, from Amit Kumar. How much weightage do you give to fundamentals of a stock in picking it?
Yeah, as I said, see, in terms of number of factors, our portfolio that we judge a stock or a sector on, roughly 40% of the weightage is given to fundamentals. So 40% of the factors are fundamentals and 60% are technical factors. That is one thing. But at the same time, the rate of change of these fundamental factors is very slow. So companies usually come out with their earnings report every quarter. So every 3 months, the fundamentals of a company would change. There'll be some update. Whereas if you look at the technical factors, uh, the rate of change is almost on a daily basis. The prices, the volumes, or the other factors are changing. So on a monthly basis, you'd see a decent change in these technical factors. So yeah, that's what it is. In terms of number of factors, it's 40%. But in terms of actual weightage, I think it will be lower than 40 because they don't change on a monthly basis so much. Okay. Any other question related to methodology?
No, Vivek, we can move ahead.
Okay. What is the ideal SIP amount and date to invest? Again, Karan, it really does not matter, frankly. We have seen that for Gulak and for index and for other instruments. Really, it's not a really factor, any factor as to which specific date you are investing. What matters is whether you are investing every month or not. That is a much bigger decision. Date really does not matter. Could you explain how stock allocation works for investment done through SIP? So I'm not really sure what the question, stock allocation. So what would happen, I think, in case of SIP is most of the times the minimum investment is 25, 26,000 and your SIP is relatively smaller, say 5,000, 10,000. So at times what would happen is you you have invested just 10,000 and the recommendation would be to buy only few stocks, maybe 4, 5, 6 stocks, and not all stocks. And the way it will work is it'll see what the money is available versus where you want to go, the model portfolio versus the portfolio that you can construct with, say, only 10,000. And that's how it will try to minimize that model error and then recommend that these are the stocks that you should invest in. So most of the times what happens is in this type of SIP, you don't really get to buy all the stocks in the proportion that we have suggested. But that difference in overall portfolio would be small and it will only be valid for 1 month. Next month, when you rebalanced, then again your portfolio will be exactly the way how it should be. right? With VIX of 17, do you have a plan to shift to less volatile stocks? Take a call after June 4. I understand you have a strong conviction on your method, but I'm just getting jittery. Yes. So I think, see, Sumit, this is again, we have a very strong conviction, and the volatility that you're talking about, it's inbuilt into the model. So when I talked about the overall macro and even the technical factors, a lot of these factors have built in a factor of volatility also. And again, I think what we have seen overall over the past many years is elections really they're not such a big event, frankly, right? Um, if you look at 5-year, 10-year returns, any election won't really matter so much. And again, there's a lot of element of luck also involved in this. What we are trying to do here is a rule-based approach, which obviously really you cannot really tell what is going to happen in these kind of events. So it's lot of it is dependent on luck, which you really cannot build into these kind of models, right? That's what I would have to say, right? And again, whatever happens on June 4th, what what we are going to do is all of that information will get reflected into the stock prices. Some stocks will go up, some sectors will go down. All of that will get reflected, and June end, when we rebalance our portfolio, it will again be updated. So it might be out of line for a few days only, or maybe for a maximum month, but there's no other way we foresee. I think anything that is likely to happen on June 4th, most likely it will be reflected in the prices in first June also when we rebalance. So most of the information that is available in the market will get captured into the prices, right? And any other factor, because of luck, if anything happens, again that will be rebalanced next month. I don't really think it's a big issue, really. Though time in the market is more important than timing the market. How to do SIP in Gulak Gear 6 in a more effective way. Sometimes if the portfolio, the realized loss takes away 50% of the SIP. Yeah, Harshad, again, see all of these points, I keep repeating myself, but that's what it is. Uh, when you mentioned if the portfolio falls 5%, that can happen, but the portfolio can also go up 5%. That has also happened. The market is always, over long run, it keeps on trending upwards. Only it has more probability of going up than going down, right? So there's no really effective way. Mostly just focus on discipline and put your money every month in the markets. Again, whether you're doing SIP in mutual funds or Gulak or any other portfolio, again, be disciplined about it. All the other factors are a matter of luck in which you don't have any control on, right? So there's no point in thinking about it, really. Okay. Okay, I think we have covered all the questions. If Simran, there are any more questions, I'm happy to take it.
Yeah, we have a question. How much amount is preferable to invest to generate proper return in Gulak Gear 6?
Yeah, I think this is a good question because if let's say somebody has just invested say 50,000, right? So the fees that you're paying us is more than 10%. So our annual fees will be 5,800, which is more than 10%. There's no way we can justify the value we are adding if you are paying us more than 10% of your portfolio value, right? I think somewhere maybe the fees should not be more than 2.5% to the maximum, right? So if you that ways calculate on say 3 lakhs, if you have invested 3 lakhs, your fees would be lower than 2%. So I think that's the amount. 2.5, 3 lakhs is what one should reach as soon as possible. And the higher you go, let's say if you have invested 6 lakhs, then you're paying us less than 1% overall. Then it becomes really very good. So the more you invest, obviously our fees is fixed irrespective of the amount. But I would say about 2.5, 3 lakhs is what one should reach as soon as possible.
Charsit is asking how money put in is different from current investment.
Okay, so Chachet, what could happen is, let's say you started with 50,000 and every month you are putting in 50,000 for 1 year. So your total money put in would be 12 months, and each month you are putting in 50,000. So that is 6 lakhs. So that is money put in. And you're asking about the second point was current investment.
Current investment, yes.
Yeah, current investment is so what would happen is this 6 lakhs you have put in, and let's say your current portfolio value is 8 lakhs, right? So that is the current value, but these say 12 stocks you have in your portfolio, the price of purchase of those stocks would be obviously if your portfolio is up, it will be lower. So let's say your current value is 8 lakhs, whereas current investment is 7.5 lakhs. So, which means these current stocks, when you bought it, at that time they were valued at 7.5 lakhs, and the money put in would be 6 lakhs, which is the money you have invested overall since the beginning. Yeah.
Next question is by Sandeep. Can we do averaging when market is down?
Again, Sandeep, see the point here is if you are lucky to get money at the same time when the markets are falling, then obviously it is a good strategy. But in order to follow this strategy, what we mean is that I'll not invest everything, I'll save some money, and when the markets fall, then I'll invest. Right? I think that's what we mean. Which means you're not fully invested in the market, which is not really a good strategy. Because what if the markets keep going up? What we have seen in last few years, I've seen so many cases where people just waited for correction, and that correction never came, and they have missed out all the phenomenal returns that markets have given in last 3 4 years. So that is the biggest risk. Once in a while markets would correct, you will enter at good price, but most likely what is going to happen is you'll miss out on the returns if the markets keep going up, and you won't be fully invested. So that's not really a good strategy. Right.
Arnav is asking for the small case actual returns. Does it use the buy and sell values at market open on the day of rebalance shown on small case?
So you're talking about the actual returns your portfolio is getting. So that it will just take the execution price. Market opened at 100, but when you bought, it might be above or below 100. So the actual traded price that you got, that's how it will calculate the returns on your portfolio, which might be the case with any other investor, because if one investor is rebalancing in morning versus one investor rebalancing in let's say later in the day, both of them would get different prices and it will impact their returns. But again, those returns, the difference in returns is not really meaningful. Okay.
Next question is by Manish. Doing monthly rebalance on month end is a manual intervention. Why don't system give a signal of rebalance? We do rebalance then rather than doing it on last or first day of month.
Sorry, I did not understand this, Simran. Can you please repeat or
Yeah.
explain me?
So I think what Manish is trying to ask is that we have a set frequency of doing rebalance at the month end or the starting of the month, but
Yeah.
maybe we should have the algo generate a signal on when the rebalance should be done in between the month as well, if that can be done.
So that is need-based rebalancing.
Yes.
Yeah, yeah. See, this I have already covered that we have tried out need-based rebalancing, and the current system works much better than the need-based rebalancing. So this we have tried out multiple ways, and the again the current system is actually the best system that we have at this point of time.
Also, I think because having like a set frequency, it makes easier for the investor also. They don't have to have a watch on when the rebalance
Yes.
is coming out. So
I think operationally, yes. Operationally, it is very easy that you are rebalancing at a set frequency. Otherwise, it will be very difficult. Even now, investors uh, miss out on rebalancing. Uh, So yeah, operationally it's very easy.
We have another question, the age old debate that whether SIP is better or lump sum is better.
I think yeah, I'm a big fan of SIP, and see, mathematically lump sum is better, right? So again, if you look at data, because markets are trending up, if you have, let's say, lump sum, let's say 10 lakh rupees, it's probably, if you just look at the probability, you have 67%, which is two-thirds of the probability that you're making a good decision by investing lump sum. But then one-third of the time, it will turn out to be against you. So mathematically, obviously, lump sum is better. But most of the investors are really worried. And what I suggest is, if you have some lump sum, you divide it into 3 or 6 equal parts, and you invest it over next 3 to 6 months. You just do that. If the markets actually you are investing over next 6 months, and if the markets fall sharply during those 6 months, you can invest everything lump sum. Otherwise, just stick to that and invest. Again, what I pointed out earlier, if you're investing for say 5 years plus, it won't really matter so much. It's not really a big decision. Most of the times, what will happen is if you're having this thought in mind, mostly we end up not investing only because we don't know what is the right thing to do. And I've seen many investors, they just sit outside because they're not sure what to do, right? So again, don't look at the market levels. Uh, I think the strategy that works for most of the investors is you divide that money in few equal parts, say between 3 to 6, and invest over the next 3 to 6 months. That is what I've seen works well psychologically for most of the investors.
One last question that we can take maybe. Sandeep is asking that whether we should invest just before rebalancing or after rebalancing.
Okay, we got a lot of questions from Sandeep. Uh, yeah, so we should. I don't think you should invest just before rebalance, because in that case you've invested in an older portfolio which is just likely to get rebalanced in next few hours or next few days, right? So if you are just few days away from rebalance, then yes, I would suggest maybe to wait for rebalance and then invest. Yeah.
Okay, Karan is saying that maybe he means that invest more option during rebalancing should be provided.
Yes, that is something I think we started our AMA with that only. Uh, that is a useful feature if we have that, and we'll again connect with small case team to figure out how we can offer that functionality. That's a useful and a good suggestion.
Okay, we have another request from Shubhankar. So, do you have a team of stock analysts or just having a tech team which is mainly working on building the algorithm? Why are you not showing much conviction if you put human intervention into the portfolio?
So our research team is comprised obviously of uh, mostly people very strong analytically in mathematics, statistics, and computer science. And at the same time, many of them have done either CFA or MBA as well, right? Either from India ISB or IIMs or even abroad, right? So it's a mix. It's a mix of people with MBAs, with CFAs, and purely from tech background as well. It's a mixed team, I would say.
Sharang is asking, is there any limit on how much money I can invest in Gulak 6?
See, what we typically say is obviously there's no limit, but uh, when this money goes higher, you actually would encounter a lot of slippages, right? So that's why we have PMS also, because in PMS we have very specific execution algorithms that we have developed in order to minimize those slippages, right? So if your money is going close to 50 lakhs or higher, I would advise you to maybe take a look at the PMS also, because again, the returns that we have shown earlier, in case of PMS, those are post your brokerage, post slippages returns, whereas Gulak, in the Gulak returns, those are pre. So in those Gulak returns, you have to subtract some percentage point because you'll be encountering slippages and other trading costs. So if your overall portfolio value is about 50 lakhs or so, maybe you can get in touch and learn a bit more about PMS. That could be interesting strategy for you. Okay.
Yeah, I think we've tried to cover all the questions. I were getting a lot of repetitive questions. So I would urge everyone to view this recording after it's been posted on YouTube. It would be available. And if you still have any questions for us, you can always reach out to our support team. Our email and phone number are both mentioned on the website. Okay. Thank you everyone for joining in. Have a good night.
Thank you. Thank you, everyone. Thank you, Simran.